I recently looked at the portfolios of 3 successful dividend investors I know. Guys who've been at this for 20 plus years. And you know what showed up in all 3? SCHD. Same fund, different amounts, but they all owned it. So naturally, I had to ask, what do they see that most investors miss? Today, we're tearing apart SCHD, the Schwab US Dividend Equity ETF. And I'm going to show you the data that made even the skeptics change their minds. Here's what most people miss about this fund. Quick disclaimer before we get started. This information is for educational purposes only. I'm breaking down publicly available data to help you make informed decisions, but this isn't financial advice. Always do your own research and consult with a qualified financial advisor before making any investment decisions. So what exactly is SCHD? It's an ETF that tracks the Dow Jones US Dividend 100 Index. That's a fancy way of saying it holds about 100 high-quality US companies that have consistently paid dividends. According to Schwab's latest fund data, we're talking about companies with at least 10 consecutive years of dividend payments. But here's what most people miss. SCHD doesn't just grab any company paying dividends. The fund uses a screening process that looks at 4 key metrics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Think of it like a quality filter that weeds out the pretenders. As of the most recent data, SCHD's expense ratio sits at just 0.06%. Over the long haul, that matters more than you'd think. For every $10,000 you invest, you're paying just $6 per year in fees. Compare that to actively managed funds charging 1% or more, and you can see why this appeals to dividend investors who want to keep more of their money working for them. The current dividend yield hovers around 3.5 to 3.8%, depending on market conditions. Not the highest yield you'll find, but here's the key. It's backed by quality companies with proven track records. Let's talk about what you're actually buying when you invest in SCHD. According to the fund's latest holdings report, the top sectors include financials, healthcare, consumer staples, and industrials. You're getting companies like Merck, Pfizer, Coca-Cola, and Home Depot. These aren't moonshot plays, they're established businesses that generate serious cash flow. Now, here's what the data tells us about performance. Since its inception in 2011, SCHD has delivered competitive total returns when you factor in both price appreciation and dividend reinvestment. During the 2022 market downturn, when the S&P 500 dropped over 18%, SCHD held up better than many growth-focused funds because of its focus on profitable, dividend-paying companies. But I've made that mistake myself, so consider this a quick save from experience. Don't confuse a good track record with a guarantee. Past performance doesn't predict future results. The market doesn't care about your retirement timeline. Bottom line is this: SCHD focuses on dividend sustainability over chasing the highest yield. That's why you won't find a bunch of struggling companies paying unsustainable 8 or 10% dividends. The fund's methodology screens for financial health first. Here's where it gets interesting. Let's compare SCHD to 2 other popular dividend ETFs, VYM, Vanguard High Dividend Yield, and HDV, iShares Core High Dividend. According to recent fund data, VYM holds about 450 stocks with a slightly higher dividend yield, but also includes more companies. That's more diversification, but also means your returns get diluted across more holdings. HDV focuses on just 75 stocks with higher yields, typically around 4% or more. Sounds great, right? But remember, higher yield often means higher risk or slower growth. SCHD sits in the middle with 100 holdings, emphasizing dividend growth and quality. Over the past 5 years, SCHD has shown stronger dividend growth rates compared to both VYM and HDV, according to fund performance reports. Think about it this way. Would you rather have a 5% yield that stays flat for the next decade, or a 3.5% yield that grows to 5 or 6% through consistent dividend increases? That's the trade-off we're talking about. For investors in their 40s, 50s, or 60s planning for retirement, the potential for dividend growth matters. It's your inflation hedge built right into the strategy. Now, let's talk about what most YouTube channels won't tell you. Concern number 1. Concentration in certain sectors. SCHD has significant exposure to financials and industrials. If those sectors underperform, it'll drag down your returns. That's just reality. Concern number 2. US-only exposure. You're getting zero international diversification here. If the US market stumbles, you're going down with it. Concern number 3. The yield isn't the highest. If you need maximum income right now, there are higher yielding options. But remember what I said earlier, sustainability matters more than raw yield. Here's what the data suggests based on historical patterns. SCHD tends to perform well in stable or rising interest rate environments because of its focus on profitable, established companies. But like any equity investment, it can still lose value during market downturns. According to market analysts, the current economic environment, with inflation concerns and interest rate uncertainty, actually favors quality dividend payers. But that's analysis, not prediction. Markets can surprise us. So, is SCHD the ultimate investment right now? Here's my take based on the data. For dividend-focused investors seeking a balance between current income and dividend growth, SCHD offers a compelling strategy backed by a solid track record. The low expense ratio, focus on quality companies, and consistent dividend growth make it a strong core holding. But, and this is important, ultimate depends on your situation. If you're 35 years old and have 30 years until retirement, you might want more growth exposure. If you're 65 and need maximum income today, you might want higher yielding alternatives. SCHD works best as part of a diversified portfolio. It's not a one-fund solution to all your investment needs. Think of SCHD as a reliable workhorse, not flashy, but it shows up and does the job year after year. For building wealth over the long haul through dividend investing, that consistency is gold. Bottom line, SCHD has earned its reputation among dividend investors through solid fundamentals and consistent execution. Whether it deserves a spot in your portfolio depends on your goals, timeline, and risk tolerance. Remember, the information I've shared today is for educational purposes. Data current as of October 2025. Markets change, companies change, and strategies that work today might need adjusting tomorrow. Always do your own research and consult with a qualified financial advisor before making investment decisions. Now, I want to hear from you. Are you holding SCHD in your portfolio? What's been your experience? Please drop a comment below and let's discuss. And if you want to learn more about building a dividend portfolio that actually generates reliable cash flow, check out the next video where I break down the strategy I've used for years. Thanks for watching, and I'll see you in the next one.